Well, Justin, let's go and get started, man. My name is Joe Massey. I am with Castle and Cooke Mortgage, and like to talk about rental properties, like to talk about helping folks buy their first home, their second home, their investment property, first, second, fifth, 10th rental property. And my job is to help with long-term conventional financing. So anything you need for properties you're going to own for a long period of time, whether it's rental properties, whether it's your primary residence, anything like that. Justin, who are you?
Yeah, thanks, Joe. I'm Justin Cooper. I'm with Pine Financial Group, and we're a hard money lender. So we're a very short-term lender. And for those who may not be familiar with that, we're going to get into what it is and how it works. And of course, how a short-term lender may be beneficial for your long-term rental holds. So we're going to spend some good time on that here in just a little bit.
All right. So let's talk about what are the most common ways to purchase investment properties. If you watch any type of late night TV or you see this stuff all over social media, there's 101 ways to buy real estate. There's 97 ways to purchase properties, 99 ways to acquire rental homes, things like this. But it's really going to boil down to just a few ways. Number one, purchase the property with cash. So this comes back to, real simple. Justin's selling a property. I'm going to buy the property, pay cash, and we're going to move along with a great transaction. Or purchase a property with a new mortgage. This is the way most of us bought our homes, right? We saved up 5, 10, 15, 20% down, purchased the property, got a new mortgage, move along making payments on that mortgage every single month. Purchase the property with a hard money loan, some sort of short-term financing, which is a big thing that Justin's going to talk about, and then refinance that into permanent financing. All right. So this is actually going to be 2 steps: buy with this short-term, this hard money loan, and then refinance into a loan like what I can provide for you. And number 4, purchase a multi-unit property. This is one we're seeing a lot more, whether it's a multi-unit, duplex, triplex, fourplex, or maybe something with an ADU or with a basement apartment. Purchase that as your primary residence, live in one unit, and then rent out the other unit. So what we're going to dive into today is, how does each scenario work? What are the benefits, the pros and cons of each scenario, and which one is the best choice? Feel free to stop us as we go along, put comments in the chat. We're happy to answer questions because I know there will be some. All right, so let's talk about scenario number 1, purchase with cash. So let's say our purchase price is $210,000. And Justin, if I pay cash for a property, do I still have to pay some closing costs?
Yeah, absolutely. Because you're still going to go to a title company, right? You're still going to have to sign a bunch of documents, right? Make it official. So yes, absolutely. There's a cost of doing that. Yeah,
you're exactly right. So even if I'm paying cash, I'm going to have to pay the initial HOA dues, the closing fee, title insurance, initial homeowners insurance, things like that. So in this case, $553 in closing costs, giving me total cash walking out of the title company, $210,553. Now, this particular property needed $0 in rehab. That's sometimes you find turnkey properties, other times you find properties that you've got to put a lot of rehab into. Really just depends. But in this scenario, total cash into the deal, $210,553. So now let's walk through a cash flow statement. All right, so this is all going to be on an annual basis, and I'm going to take a little bit of time on this first one to really break it down, and then we're going to speed up as we go along through future examples here, but I want to make sure you guys are understanding the concepts here. So the rental income is $1,800 per month. Now we're going to multiply that by 12 months, gives us $21,600 per year. And then we're going to have vacancy. Now, Justin, tell us a little bit about vacancy. What does that mean?
Yeah, so vacancy is when the property is going to be vacant, when there's not going to be a tenant in there, more specifically when a tenant's not going to be paying rent. So we're assuming 5%, which is roughly 3 weeks a year. So we know we're going to have turnover, right? We're not going to have one tenant that stays for the next 30 years, although we all hope that happens. Probably not going to happen. So what we're accounting for is about 3 weeks of turnover from the time they move out to the time we have somebody else move in and start paying rent. So maybe we've got to do a quick turnover and clean up. Maybe somebody stays for 2, 3, 5 years and then they move out. And maybe then we're going to have a bigger turnover. I'm actually in the middle of that right now. Somebody's been there for the 5 years I own the place. But now that they moved out, we're doing a whole new renovation on the place. And so it's going to take longer than 3 weeks to turn it over. But I haven't had any vacancy over the past 5 years. So in this case, it kind of all evens out. What we're doing here is a placeholder, knowing the property is going to be vacant for a certain amount of time. 5% is a really good rule of thumb to have in there.
Yeah, I think you're exactly right. Having that 5% vacancy in there. And right now in Denver, vacancy is, I just saw the report the other day, is 2.6%. You guys are going to see, we like to be kind of conservative in our assessments here. We've got a lot of data going back 40, 45 years, et cetera. 2.6% right now for vacancy is historically low. But we still like to factor that in because you're always going to have some type of vacancy throughout the time that you own the property. So we're going to subtract that vacancy, roughly 5%, to give us expected annual rental income of roughly $20,000. Now, the next section we've got in red are going to be the annual expenses. Number one, property management. Now, I'm a big advocate for managing or for having a property manager. I do not like to manage properties on my own. But Justin, you do a little bit of a mix, right? You've got a property manager, but you manage some of your own. Is that right?
Yeah, so I started off managing all my properties myself and kind of figured out that I'm not a good property manager. In some ways, I think I just have too big of a heart, really. We'll say that's what it is. Right. But I do still manage. I still do manage one of my units. She's been there since we bought the unit about 9 years ago. And she's just a very easy, low maintenance tenant. Pays on time, easy to work with. And so I don't see a reason to turn that one over to a property manager, but all my other units are with a property manager.
Yep. And I always factor in 10% of those annual rents for property management. Sometimes managers will be a little less. Sometimes they'll be a little bit more. Sometimes they have a charge for leasing the property, and then it's a lower percentage. In general, it works out to roughly 10% per year. Some years a little more, some years a little less. Reserves. All right. So Justin, do you have to make repairs on your property every single month?
No.
I agree. I don't either. Fortunately, most months we don't have to make repairs, but some months we do. And so we factor in 8% of the gross rents for repairs and maintenance. And you might go along, you might have 6 months, there's no repairs. All of a sudden, water heater goes out, $1,000 repair. And that's what this reserves are for repairs and maintenance, is factoring in there's going to be some sort of repairs as you go along throughout the year. Or maybe it's over the course of 5 years. You just mentioned you've got a big tenant turnover. You've been reserving for those repairs and maintenance. Now you've saved up $7,000 over 5 years. That's the money you're using for paint, carpet, refresh, right?
Yeah, that's exactly right. And to be honest, that's almost exactly what the budget's going to be. It's going to be maybe closer to 10 grand. It's actually going to be a little bit more because we're repiping, redoing all the plumbing. But that was something we knew from the very beginning. So actually what we were doing is setting aside a little bit more than that each month for this property, because we knew when we had a turnover, it was going to be more expensive. But without the replumbing, it actually works out to just about exactly what we're reserving here for repairs and maintenance.
Excellent. Now, HOA dues. This particular property that we're looking at is a condo. Not every property is going to have a homeowners association. Some are going to be more, some are going to be less. This one's a little more on the expensive side. It's like $390 a month. But the HOA is going to cover the exterior maintenance, common area maintenance. You might get a pool. You might get trash removal. I know in this one, heat is included. The water is included in the HOA. So we're going to factor that in. Property taxes, we always look those up online. These are the real property taxes. And then property insurance. This was the real insurance just for the interior of the unit. So a lot of folks say, well, wow, $499, that's really low. Well, it is really low because we're only looking at the interior of the unit. The homeowners association is covering things like the roof, the exterior, etc. Now, I've left this next section in here just so we've got a real clear breakdown. But there are no other expenses associated with this property. So water and sewer, trash, electric, that's paid by the HOA. Electric is paid by the tenant. Landscaping is paid by the HOA. And then on the spreadsheet, which if you guys have not seen that, you can download a copy from our website at loansbyjoemassey.com. Justin, if you don't mind, maybe put that in the chat box. The website is loansbyjoemassey.com. You can download this spreadsheet and you can customize it for individual properties that you're looking at. So if you've got something like an other, if there's, I don't know what else there might be, snow removal maybe that you have to pay for, or any other type of ancillary expenses that you have to pay for, you can change this and include these expenses. So total annual expenses, $10,282. So we take the expected annual rental income minus these expenses is going to give us this net operating income, $10,238. Now there's no mortgage payment. All right. And you'll remember we paid cash for this property. We did not take out a mortgage. So our annual cash flow is $10,238, which equates to what's that? About $850, $900 a month, I believe. Pretty decent cash flow. But let's look at how does this result in a cash rate, a cap rate and a cash on cash rate of return. Well, these two numbers are exactly the same, which makes sense, right? We paid cash for the property. So our annual cash flow before taxes and our cap rate are exactly the same. So Justin, let me ask you, 4.9% cap rate, good deal, bad deal? Would you buy this deal?
Personally, I think I would buy this deal. But a 4.9 cap rate, we're in interesting times here. Middle of 2023, the market is changing a lot. And so if you caught me 6 months ago, a year ago, I would have said a 4.9 is probably pretty good. But moving forward through the end of this year, I would say maybe it's not as good as it could be or should be. But the point is the cap rate is a way for you to compare different properties or compare the different assets in your portfolio. And so if a 4.9 is good for you, then that's what really matters most. But understanding what it is, where it comes from, that's the importance of it all. And so for me, I think based on these numbers, I would probably buy this property.
Yeah, I think you're exactly right. And we're going to talk a little bit more about the purchase of this property, but there's also additional ways to make money in real estate outside of the cash flow. And that's a big thing we want to look at today. You had really touched on an important point. We're in kind of different times than we've been in the past, that it's more difficult to cash flow on a property because we've seen prices run up a lot. We see interest rates increase a lot. We've seen rents increase, but they're not keeping pace with the increase in property values, and they're not keeping pace with the increase in interest rates. So what are the other ways that you're going to make money on a property? So our good friend James Orr over at Real Estate Financial Planner came up with the concept of the return on investment quadrant. All right. And there's basically 4 different ways that you're going to make money. Number 1 is the cash flow. All right. So this number is at $10,238. Number 2 is depreciation. All right. If you're not familiar with that, the IRS allows you to depreciate properties over a time period to account for wear and tear and depreciating that property down to 0. And so on the spreadsheet, we calculate the true cash value of that depreciation. So based on your tax bracket. So you can also get return based on debt pay down. Now there's no debt pay down on this one because there's no debt. We paid cash for it. A lot of people say, well, why is there a return based on debt pay down? Well, Justin, let me ask you, who's paying down the debt? Me as the investor, if there were a loan on this property?
No, it would be the tenant.
That's right. The tenant is paying down that debt. So every month the tenant pays us their rent, then we pay the mortgage, and that a portion of that mortgage payment goes towards the principal, and that is a return that we're getting. Now it's difficult to access that return without refinancing or paying off the property, but it's kind of like the real estate piggy bank, right? That it's going in and it's building up a value because that debt is being paid down. And then one of the best places is appreciation. Now, right now, over the past 40 years in Denver, we see that properties appreciate an average of 6%. Over the past couple of years, we've seen 18, 20, 25% in some pockets. What I always like to use is an average of 5%. So we've looked at a ton of stuff this year. I believe this year in 2023, we're going to be plus or minus about 3%. So we're going to be a little bit below average. But what I like to use is that 6% average. I take a little bit of a more conservative approach and say 5% appreciation, which makes sense, right? This $210,000 times 5%, this property is going to appreciate roughly $10,500 in the first year. Because that's what this return on investment is giving us, is this first year return. So we're going to tally up these 4 quadrants, and that's going to give us a total of $22,815. Now we're going to take that initial return of 22,815, and we're going to divide it into the total cash into the transaction. And then that's going to give us our return on investment in percent format. So our cash flow is a 4.9% return, which makes sense. That's the same as our cash on cash return. We're getting a 1% return from depreciation. We're getting 0% return from debt reduction because there is no debt. And we're getting 5% appreciation return, which gives us a total of that 10.8% return. Now, Justin, let me ask you, this is a 4.9% cap, but that 4.9% does not capture all of the quadrants that you're making money. So now knowing this is a 10.8% return if you pay cash, does this seem like a good deal?
It seems like a much better deal. Absolutely.
I agree. Now, a lot of folks say, but yeah, Joe, I really want a property that's going to cash flow. And this property does cash flow right away. Oops, let me erase all my notes so you guys can see that more clearly. So when does the property cash flow? Right away in year number 1. And then on the spreadsheet, we've got a graphical representation of each of the 4 ways that you're making money. In the red is debt reduction, which you see we really make no money on that because there's no debt. Depreciation is in yellow. The cash flow is in green. The appreciation is in blue. And when we tally those up, you get this white line that is your entire return on investment. And so we take it out to the end of 30 years. This property is going to be returning $85,000 a year 30 years from now. And that's going to be accounted for in cash flow and appreciation. So Justin, knowing we're going to get cash flow in year number 1, and then knowing that in 30 years, this property is going to be returning $85,000, do you still think this property is a good deal?
I mean, it sounds like it's just going to keep getting better and better each year.
Yeah, I think so too. So what are the big benefits? All right, you're getting a 4.9% cap rate. You're getting a 10% return on investment. You don't have to qualify for a loan, right? You don't have to mess with pesky lenders asking for your bank statements, your credit report, your credit score goes down because of a credit inquiry, all these things. You don't have to deal with that. You have no monthly payments, so you're going to maximize your cash flow. Well, what are some problems? Number 1, you have to have a large amount of money. All right, Justin, what if I don't have $210,000? Could we buy this property?
Not using this scenario, not paying all cash, you can't.
Yeah, you're exactly right. Or what if I have $250,000? How many of these could I buy?
Yep, you can buy just one doing
Just
it this
one, right? Just one. Now, going through this, I agree. I think it's a pretty good deal. Justin, you think this is a pretty good deal. What's the number one piece of feedback that we get when we break down this slide? Do you know, Justin?
That you can't find a property for $210,000 in today's market.
These properties do not exist anymore. And that's true, except for all the ones that are out there. All right. Yep. So this property was on the MLS in a seller's market with less than 1.6 months of inventory. And every transaction we're going to show you today is a real transaction that myself personally worked on, or Justin worked on, or we both worked on. So this one is actually a property that I purchased. These are the real numbers. Closed on it less than 10 days ago. So these are the real numbers for this particular property. All right. No questions I see in the chat box. So let's keep going to our next scenario. Justin, anything to add on this one?
No, I was just going to say that I also bought not this exact property, but a property with almost the exact numbers like 2 years ago. My purchase price was 200 even, and the rental income was 1896. Yep. Other than that, almost identical. So.
Oh, and one question, where is the property? It's in Denver. This property is in Denver, just north of the Denver Tech Center. So it's important to understand some of the transactions we're going to show you are going to be Lakewood, Westminster. Sometimes we see things in Pueblo. This particular property in Denver, just north of the Denver Tech Center. All right, let's look at scenario number 2. Let's purchase with 15% down. So Justin, what's the minimum down payment that we need for an investment property? And hint, hint, it's on the screen.
I'm pretty sure it's 15% down, Joe.
That's right. Now, a lot of people think the minimum down payment is 20%, 25%. We can actually help you with as little as 15% down for a conventional loan. We're going to talk in a little bit about how Justin could help you with even less than that. So purchase price on this was $263,000. We loaned the client 85%. They put 15% down, Now, when you put lower money down, you do have a little bit more in closing costs. So walking out of the title company with the keys to the property, they spent $45,950. This property needed about $6,000 of renovation, not a ton, but I think that's a reasonable amount for a condo, interior paint, maybe a slight bathroom refresh, maybe carpet. You mentioned you're doing one right now for less than $10,000, but that includes a lot of plumbing and repiping, right, Justin?
So that one's going to be just over 10 grand. Yeah. But yeah, we're replumbing the whole house, replacing a bunch of windows, other things like that.
Yeah. Total investment into this transaction, $51,950. So now let's look at this annual cash flow statement. So the property rents for $2,250. Now, an important point, this is not a property that I personally purchased. This is one of my clients that purchased this property. So I helped with the new loan, but these are all real numbers. Minus vacancy, property management of 10%, reserves for repairs and maintenance, homeowners association. So this one's about $275, I think, or $265 a month. These are the real property taxes, and they got really, really good insurance for $214 per year. So total annual expenses, $9,326. So estimated annual rent, expected annual rent minus expenses gives them that net operating income of $16,324. Now the mortgage payments, again, this is our annual cash flow statement. These are the annual mortgage payments, roughly $19,450, and mortgage insurance. Now, Justin, why did they have to pay mortgage insurance?
Well, because they put down less than 20%.
That's right. They only did 15% down. So you do have to pay mortgage insurance. You can pay it monthly, or you could pay it upfront one time. And so what you see is their cash flow is negative. All right. It's costing them $4,000 a year to own this property. So 4,000 divided into 12, what's that? About $360 a month. Justin, good deal, bad deal? Would you buy this so far?
For me, no, I would not buy this. One of my requirements is that the property is cash flow positive and is cash flow positive by at least $500 a month.
Okay. So I love that. And that's a great answer because you're a sophisticated investor and you have thought through what are the requirements that you have for you to be willing to purchase a property. So this does not meet your metrics, but just because it doesn't meet your metrics, does that mean it's a bad deal?
It does not mean it's a bad deal. It's just not a deal I would do.
It's not a good deal for you, right?
Correct.
Well, let's 100%. Look at the return. Let's look at the cap rate. All right. This is a 6.1% cap rate, which is pretty solid in today's market. Cash on cash, though, is negative. So it's important to understand this negative cash flow is really just decreasing the amount of income that you're making. And you could get to positive cash flow, but you might have to put more money down. Well, how does that convert to our return on investment? Okay, so we've got cash flow of negative $4,088, but we're depreciating the property for $2,600. We're paying down the debt by $1,900. And again, who's paying down the debt, Justin?
That would be the tenant.
That's right. The tenant is paying that down. And then this property is appreciating at 5% a year, giving us a total of $13,000 in return on investment. Well, let's convert that over to our percentages based on our total investment of $51,000. We have a 7.8%, negative 7.8% cash flow, 5% depreciation return, 3.6% debt pay down return, and a 25% appreciation. Now, Justin, is the property going up by 25%?
Well, Joe, this is an interesting question, man, because I was going to ask you. So we went over these numbers on that first scenario. And so when you circle the dollars on the right-hand side of the ROIQ, those dollars are representing the same percentage we talked about on the first slide, correct? So the appreciation percentage overall is still what, 5% that we calculated?
That's right. So this 263 times 5% is 13,150. So the property's only gone up by 5%.
So then how do we get an appreciation percentage of 25%, Joe?
Yeah, so that's the great thing about leverage. We got a loan, or the client got a loan from me, so they didn't pay $263,000 in cash. They paid $51,000, almost $52,000 in cash. So they're getting this return. The entire property goes up, but they only invested 15% into the property. So they're getting a higher return on their dollar, which results in a 25.9% total return on investment. So if you're looking for total return on investment, would you rather have this deal, Justin, or would you rather have deal number one?
So the total return in this deal makes much more sense.
Yeah, I agree. But for you, you're looking for cash flow. So deal number one makes more sense for you, right?
If we only had the two to choose from, then yes, deal number one.
That's right. Now, I really like what Justin said is he's focused on properties that cash flow. So when does this property have positive cash flow? Not until year number 7. And here's what we're assuming on that. We're assuming rents are increasing by 4% a year, which has been the historical average over the last 40 years. All right. We're also assuming inflation of expenses at 3% a year, which is maybe a little low right now, but the historical average for appreciation over the last 40 years has been 2.5%. So we assume that your expenses are going to go up by 3%. So this property does not achieve positive cash flow until year number 7. But here's the interesting thing. What other things are you achieving every single year? All right. You're still getting depreciation. You're still getting debt reduction. You're still getting appreciation. So this white line here shows that in year 30, you're going to be getting a return of $115,000 per year on this property from cash flow and appreciation after your loan is paid to zero and you're no longer getting depreciation. So thinking about it this way, Justin, still a pretty decent deal if you're focused on return on investment?
Yeah, absolutely.
Yeah. But you do have to stomach, it's going to be negative cash flow for 7 years, right?
Yeah, exactly. So we got to really prepare ourselves. If this is something we're looking to do, it can be a great strategy because you're only putting 15% down. But the other side of that, right, where are you making up the other, you're almost like spreading out the other 5-10% down over the next several years at whatever it is, $350 a piece that we're making up the difference in our negative cash flow.
Yeah, you hit the nail on the head. This negative cash flow, I often describe that as deferred down payment, meaning I could put another 10, 15, 20% down right now and maybe get positive cash flow right here in year number 1. But instead, I'm going to put less money down and make small payments every single month. All right. And then I'm going to be getting positive cash flow at a later date. So you can do it one of either way, right? You could put more money down today, cash flow immediately, less money down today, less cash flow now, but more cash flow potentially in the future. But here's what you're getting in both scenarios: debt reduction, depreciation, and appreciation. So these 3 items, debt pay down, depreciation, and appreciation, are not dependent on how much money you put down. Well, let me take that back. Debt pay down, that is factored in based on how much you put down a little bit, right? So if you put more money down, you're going to have less return on your debt reduction. So let me take that back. All right. Big benefits here: 6.1% cap rate, 25% return on investment, much less cash into the deal. So Justin, I used the example in the last slide. If I have $250,000, how many of these properties could I buy?
Yeah, more.
Yeah, I could buy 4, maybe 5 properties,
exactly.
Right? So It allows me to buy more properties, which in 30 years is going to get me a much bigger return. But here's the downsides. This is negative cash flow, or as we called it, deferred down payment. I do have to qualify for a new loan, right? I've got to provide my tax returns, my paycheck stubs. Vacancies are going to have a bigger impact. And depending on the condition of the property, it might not qualify for financing. And we're going to talk a little bit about that. And that's one of the things that Justin has some great options to help us on. But in this case, I think this is a pretty solid deal if you're comfortable with negative cash flow. But if you're not comfortable with negative cash flow, let's look at some other options. Oh, and I almost forgot. This was several months ago, 1.3 months of inventory, and this was on the MLS.
Yeah, Joe, I really like that strategy, the 15% down. Not necessarily for the person who has 250,000 cash, although if they're interested in it, they should absolutely pursue it. But for the person who has 15% down, right? Maybe they've got a really good job and they can stomach the negative cash flow each month, but they don't have $200,000. They don't have $100,000 yet, right? They got enough to put 15% down and have some reserves. If they're comfortable in their job and don't feel like, there's risk of losing it or changing or anything like that, but they want to get into property sooner than later. I mean, looking at this amortization, looking at the chart you have on here, you can see that if we waited 7 years until we were able to put a big enough down payment down potentially and get into this, we're missing out on a lot of benefits of owning real estate. So, I mean, it's not saying everybody should jump in just because they have 52 grand, but if you're comfortable with all those other risks, you know, and if you found ways to mitigate them, this is a great way to get into property sooner than later.
Yeah. Yeah. I think you're exactly right, because what a great point. If I'm going to save up enough money to have a down payment, so this property is going to cash flow and I'm going to buy it here in year 7, or we'll now call that year 1, what's the value of this property going to be 7 years from now? Right? At 5% appreciation, it's going to be $350,000, $360,000, $370,000. I got to have a lot more money to make this property work. So Justin hit the nail on the head. A lot of our first-time investors or folks that don't have a ton of cash do these 15% down options because they know, hey, they're going to be taking advantage of this appreciation for the next 7 years. And before long, this property is going to be positively cash flowing, but it's going to be worth a heck of a lot more. So really a great point, Justin. All right. And did I see any questions in the chat?
Kathy had a question, major renovations required. I'm not sure if that was for scenario 2A or for scenario 1.
Yeah, scenario 1 was no. There was no renovations on scenario number 1. Scenario number 2, $6,000 of renovations. So not a ton. This was a condo in South Aurora, and it did not need a ton of renovation. So pretty basic. I think it was some paint, maybe a light bathroom refresh. And maybe some carpet in 1 or 2 of the bedrooms. So not very much. All right, let's talk about scenario 2B. Let's purchase with 25% down. So this was a transaction that I am seeing a lot more of. This was a single family home with a basement apartment. So they paid $475 for this, and we loaned them 75%, which was a new loan of $356,000. So they put $118,000 down. Closing costs are a little bit less when you put more money down. Total investment into the transaction, $124,000 walking out of the title company with the keys. Now, this property needed $25,000 of renovation. So this basement apartment was not in great shape. They had to add a kitchenette. They had to add some egress windows. They had to add some venting for the kitchenette. The property did have an exterior door into the basement apartment, but they had to do some medium level, we won't say major renovations, we'll say medium level renovations to make that basement apartment livable. So total investment of cash, $149,000 to get this property ready to rent. So the annual rental income, $3,200 per month. So they rent the upstairs, the main level, for $2,000 a month. The basement apartment is rented for $1,200 a month. So $3,200 a month is $38,000 a year, minus vacancy, minus property management, minus reserves, real estate taxes, and homeowners insurance. Now keep in mind, there is no homeowners association because this is a single family residence. Okay. So total annual expenses, $8,900. Net operating income, $27,000. Now, what's the biggest expense is always the mortgage. Okay. The mortgage is your biggest expense, but here's the cool part. It's also the only expense that is inflation protected. If you take out a 30-year fixed rate loan, that mortgage does not go up. It remains exactly the same every single month. Now your taxes might go up, insurance might go up, property management might goes up, repairs, things like that could go up, but your biggest expense doesn't change. So what do you see here? Negative cash flow still, but not nearly as much, $1,625 of negative cash flow. Now, Justin, you only buy for positive cash flow. Is this getting closer than the prior scenario?
We're getting closer.
We're getting closer. All right. Now, this one is a 5.5% cap rate. Not bad, but we're still negative cash flow. How could I make this positive cash flow on year number 1, Justin?
If you put more money down.
That's right. And that's kind of what we're seeing in the Denver market right now is if you want a cash flow and you're buying a property like this, it's generally 30% down. And that is just a function, like we mentioned earlier, prices have gone up, interest rates have gone up. That's their biggest expense, the mortgage, and rents have not gone up and kept pace with those increases. Okay. But let's look at other ways that this property is going to help you make money. So you're going to have some cash flow, which is unfortunately negative to begin with. but you're getting depreciation. You're getting more depreciation because it's a bigger property. Debt reduction, you're getting more debt reduction because the tenant is paying down on a bigger loan. You're getting appreciation of 5% for a total of $30,000 of annual return in year one. Let's divide that into this $149,000 initial investment. That's going to get us a total of 20% initial 1 year return on investment. Justin, pretty decent deal?
Yeah, those numbers sound really good.
Now, let me ask you, this is cash flowing less negative, so cash flowing a little better than scenario 2A, but we're getting a worse return. How is that possible?
You tell me, Joe.
Well, the big difference is how much we're investing. All right. So we're investing more money, which gets us a little bit better cash flow, but now we're not getting as high of a return on a percentage basis from some of these other sources of return. But now, when does this property achieve positive cash flow? Let's look at that. Year number 3. All right. So when we're putting more money down, we're going to achieve positive cash flow much, much sooner. We're still going to get depreciation. We're still going to get debt reduction. Our cash flow is going to be really, really strong. Appreciation really strong. And in 30 years, this property is going to be returning $196,000 per year. So think about that. In 30 years, the property is going to be returning more than we invested in it on an annual basis. That's kind of crazy, right?
Yeah, that's pretty awesome.
Okay.
And so to your point there, Joe, right? When we're looking at these percentages, it's the cash that comes in versus the cash that goes out, right? So how much cash flow do we have coming in versus the total cash into the deal? So this one with the almost $150,000, right? The 25% down and the 25,000 in rehab, that's a lot of money that went out of pocket, right? So when we're comparing how much money is coming in, that's why it's so different, because we had so much more out of pocket.
That's exactly right. We've invested more money. We're not getting quite as much return percentage, but we're getting still a good dollar amount return. So we're getting a 6.5 cap rate, 20% return on investment. We're closer to break-even cash flow, so it takes a shorter period of time for us to achieve positive cash flow. But we still have to qualify for a new loan. The property may not qualify for financing. And what if I had my same $250,000? How many of these could I do, Justin?
It looks like just one of these.
Yeah, maybe I could do one of these and then maybe 2 of scenario 2A, right? And that's a common one that I'll see, especially with folks that have a 1031 or maybe selling one property and they need to spread that money out, or they choose to spread that money out over a couple of properties. They might buy one of these and maybe 2 from scenario 2A and have multiple properties appreciating. So it's important to always look at how much cash do you have and how many properties do you want to achieve, because I think the more properties you have, the bigger impact this $196,000 is going to make 30 years from now.
Yeah. And Joe, that's a really good point, right? It's not just one way or no way. It's how can we mix and match, right? That's why we have these different scenarios, is because every investor, one, has their own strategy, but then 2, how can we mix and match the different ways of approaching financing or the different types of deals, right? No rehab, some rehab, to fit our goals, right? It's not just here's one way and that's the only way.
Yeah, that's exactly right. And this was several months ago when we were just over 1 month of inventory, and this was on the MLS. So again, a lot of folks say, hey, there's no deals out there. You might have to look a little bit harder, but there are still transactions out there. So let's talk about, before we look at scenario number 3, let's talk about the process of purchasing with a hard money loan. So Justin, this is really your area of expertise. So take it away here. How do we buy with hard money?
Yeah, thanks, Joe. So a lot of this looks very familiar, where we're going to locate the property because, one, we are an agent, or we're working with a real estate agent, or maybe we have wholesalers that we're working with to find investment properties, or maybe we're just doing the things that wholesalers and larger investors do, which is direct mailing, knocking on doors, right, going direct to sellers. But one way or another, we're going to locate a property, okay? And then 2, we're going to start analyzing the deal and make sure that property is going to fit our criteria. And if it does, we're going to go under contract. We're going to put together a solid scope of work. And the reason you need a solid scope of work is when it comes to hard money loans, the uglier the better. So scenario 1, where we're buying a turnkey property that needed 0 repairs, that's not really an ideal property for us as a hard money lender, because as you get uglier, The uglier you get, the more upside potential there's going to be, right? We're forcing appreciation. We've been looking at appreciation of 5% a year, but what we're going to be doing here by using a hard money loan, by finding the uglier properties and fixing them up, we're going to force appreciation. We're going to pop that value really quickly by putting in a lot of work and fixing it up. So we find a property, it makes sense, we're put it under contract. Now we're going to go to the third step, which is get a hard money loan. And so this is where we're actually buying the property. And Joe makes an interesting note here, up to 70% of the ARV. So for those who aren't familiar, the ARV is the after repair value of the property. So in all the other scenarios, our purchase price basically is the value of the property because there is no significant upside to it. So what we're buying it for is the as is value, but the ARV is the as repaired value. So if we're buying it ugly, we're going to fix it up. We hope that fix up will then pop that value up even higher to what we're calling that ARV. And that ARV is what hard money lenders look at when we're making our loans. So Joe uses the as is value when he gets an appraisal. I, as a hard money lender, look at the as repaired value. So we're going to go into that a little bit deeper here in just a second. But so we get the hard money loan. We know we've got our how ugly it is. We know how much it's going to take to fix it up. We know how much it'll be worth after it's all fixed up. Now we own the property. Now we're getting our contractors in and doing the work. So we're repairing the property. Once it's all fixed up and beautiful, or as beautiful as you want your rental property to be, then we place a tenant. And once the thing has a tenant in there, now we're going back to Joe and getting it refinanced, because a hard money loan is a very short-term loan. Okay. I look at hard money as a short-term, high leverage loan. The high leverage meaning you're borrowing more money than, typical lenders like Joe can do. And the short term, for Joe, a short-term loan would be like a 15-year loan, right? Yeah. For me, when I say a short-term loan, I'm talking months, not even years. So our typical loan is 9 months long. So there's no long-term wealth of a rental in a short-term hard money loan. So you want to buy it with the hard money, fix it with the hard money, and then refinance out of the hard money into that long-term loan. And that's where Joe comes in. Joe can finance up to 75% of the new appraised value. And what that new appraised value is, right? Joe's worried about the as is value, but the new as is value is basically the same as my ARV, right? Because now it's all fixed up. Now the value should be up here. So when Joe comes to value it, his new as is value should be the same as my ARV. Joe can lend up to 75%, where I could loan 70%. So if apples are apples on our value, Joe can come in with his loan, pay off the hard money loan in full, and we've got a 5% spread there, the 70 versus 75, which means we should be able to roll in the closing costs of the new loan into the loan. Okay. So we're going to talk a little bit more about these moving parts on the next slide, but Joe comes in, refinances out of the hard money. You're into your 30-year fixed loan, and now you're off to the races, right? You have your property manager, or you're managing the property yourself, and you're sitting back, collecting that mailbox money, living the easy life. Sort of. So walk us through this scenario. We're going to purchase with a short-term loan. So we're going to get a hard money loan from Pine. We're going to refinance with our permanent conventional financing. And this was an 885 ARV. You remember this one. This is that duplex, which was in, I do believe, pretty rough shape, I think was reflected here in the purchase price, right? Yeah, exactly. Right. So this is where we can really see that the property was in rough shape. If we know the pretty properties, the pretty duplexes can sell for $885,000, but this one is listed for $350,000, $400,000. Okay. In this case, we were able to get it under contract for $370,000. That's a huge spread, isn't it? So that points us to how ugly the property is without actually looking at the property, without seeing the pictures, without reading the description in the MLS, right? We know this thing is in rough shape. So knowing it's in rough shape, walking through it, knowing how nice we want our rentals to be, knowing what the market is saying an $885,000 duplex should look like, we can then figure out, here's how ugly it is, what it needs to look like. That's going to cost us $175,000 to do that work. Okay. Now that's not a small amount of money, right? $175,000. That's not for the faint of heart. But if you're willing to take on that challenge, let's keep looking through this. Now, the closing costs to buy this with a hard money loan, $27,000.
So hold on, that seems really high. Why is that so high?
Yeah, that's because of this guy, right?
Right.
That's where the hard money comes from, okay? Because it's hard on your wallet. It's not actually the definition of hard money, but it is true, right? Hard money is expensive. So when we talk to Joe, we're talking about interest rates. That's what he charges, and we're talking in single digits. But when we're talking to hard money lenders, we're talking about two different costs. We're talking about points and interest. Points is what we charge in origination. It's what we charge to make the loan. Sometimes that comes up in your conversations with Joe. Sure. But maybe it's 1 point, maybe half a point, somewhere in that range. For hard money lenders, it's usually multiple points, 1, 2, 5 points. And then also the interest rate is almost always going to be double digits. So it's a significantly higher cost loan, but it's a very, very short-term loan. It's always really important to remember how short-term these loans are and put everything into perspective. So closing costs on this deal, $27,000. So if we're adding up the purchase, the repairs, and the closing costs, it came to $572,250. Now, I said I can lend up to 70% of the ARV. So what is 70% of 885, Joe?
Oh, I don't have my calculator.
You're right. Sure it's more than 572,000. It's over 600. Okay. So in this case, you don't need all 600. So I'm not going to lend you extra money because you don't need that extra money. What you need is enough to cover the purchase price and the repairs and the closing costs. And if I'm able to give you all $572,000 that you need, how much money do you have down at closing?
$0.
Correct. Okay. So this is actually a phenomenal deal when we're looking at it from a percentage wise, because I think it's actually 67% of the ARV that you needed. Okay. Yep. You don't even need that full 70% that I could lend.
Yep.
Now, $175,000 is not something you can knock out in a couple of weeks, at least not something that I can knock out in a couple of weeks. And most of my clients can't do that in a couple of weeks. In this case, it actually took the client about 8 months, 8 months to get the repairs done, and then also a little bit to get the refinance done. So 8 months cost about $6,670 per month. So total over those 8 months, $53,000. Okay. Again, that's $6,670. That's that double-digit interest rate I was talking about earlier. So $53,000 out of pocket in holding costs. Okay. Now, once we're all fixed up and pretty, we've got tenants in there, we're rocking and rolling, we're going to Joe for the refinance. Joe can come in, he gets an appraisal done on the property. Also, let's say at 885. So he can then pay us off at the 572. The closing cost for the new loan, $7,750, right? Now, because of the loan to values in this case, Joe can roll those closing costs into the new loan. So your actual cost of the loan amount on the new loan is $580,000. So the cash needed for the refinance, this is important because some people do need to bring some money to closing, but in this case, in this scenario, $0 to closing on the refinance. So zero money out of pocket when you bought it with the hard money, zero money out of pocket on the refinance. And yes, there was some money out of pocket during the holding time. Total cash into the deal, $53,360.
So now let's walk through the rental statement or the annual income statement. So this is a duplex. It's rented at $2,900 per side. So $5,800 a month, just under $70,000 a year, minus vacancy, $66,120. Now, property management, more expensive, bigger property, makes sense, right? Reserves, bigger property, more reserves. Real estate taxes, bigger property, more taxes. Insurance, bigger property, more insurance. No HOA because it was just a true duplex. So total annual expenses, net operating income, $46,000. What's your biggest expense? You got to pay the mortgage. So now we have negative cash flow of $799. So Justin, would you do this deal?
I would not.
You would not. Okay. Because you want cash flow, right?
Well, one, yes, that's correct. Two, it's that $175,000 budget. I had enough trouble managing just the basement renovation in my personal house for $30,000. So $175,000. That's bigger than I want to mess with.
It's a lot of work. It's a lot of work. And that's you being a self-aware investor, right? I could not do a $175,000 renovation either, but you know who I know that does it? Like 10 or 20 or 30 my investors, my clients, just like yours. All right. And here's what they get for being able to do that work. Number one, they get an 8.1% cap rate. All right, which is really, really high.
That's the best cap rate we've seen.
Yeah, that is the best cap rate we've seen. And the more important thing they're getting is a really good return on investment quadrant. They're getting a lot of depreciation. They're getting a lot of debt reduction. Depreciation on a percentage basis and debt reduction on a percentage basis is huge because remember, they're only investing $53,000. They're getting $44,000 of appreciation, which is only 5%. All right, that's only 5% of this 885. So let's not forget that. But on a percentage basis, this property is giving them a 108% return or $57,000 a year on a $53,000 investment. So Justin, does that now seem like a more appealing deal if, you had somebody to do the renovations for you?
Yeah, I mean, that's an incredible return.
Yeah, I agree. Absolutely an incredible return. So now we do still have the problem that it's negative cash flow. Well, look at this. It achieves positive cash flow in year number 2. Doesn't take a whole lot of time of having that property rented and having 4% rent appreciation for that property to be achieving positive cash flow. And then what happens in 30 years? This property is returning $352,000 a year from cash flow and appreciation. Pretty decent deal, I would say, right? But what's the downside? You got to do a lot of work. $175,000, that is a major renovation. Now, where did they find this? They bought this from a wholesaler. We talk a lot about this in the Pine Financial Happy Hours. We talk a lot about it on the Pine Financial YouTube channel, which if you've not subscribed to that, make sure you do that. This was in a seller's market with less than 1 month of inventory. So wholesale can be a great route to find properties. Now, before we go along here, there's a couple of questions in the chat. Let's see. Interest rate, 12.9%, you said, Justin. And how often are you seeing people sell versus rent after buying with hard money loans? Justin, what do you think?
Yeah, that's a really good question. And I think what you're implying is, do people change their strategy? Because when people go into this property, like let's take this duplex right here as an example, they're going in saying, I'm going to buy this and keep it as a rental. And so that's their strategy. So usually, unless there's something big that happens outside of their investment, something big in their personal life, generally speaking, they're staying consistent with their plan because, there's a couple reasons. One, you're rehabbing. The $175,000 is to not make this a beautiful new build quality property. This is to make it a bomb-proof rental property, right? If I was going to do this as a fix and flip, I would probably spend maybe $250,000. I would have nicer finishes, nicer appliances, different countertops, right? Maybe different color paint, those types of things. So going into it, I have a plan for a rental. And if I execute that plan, again, barring any major changes, I'm going to continue down that path. Same thing for a fix and flip. If I plan a fix and flip, if I do the quality of a fix and flip, then the plan is to sell the property. So do people change? Yes, absolutely. Can they change? Yes, there's nothing, you're not going to get sued necessarily if or foreclosed on or whatever could happen if you pivot. But the majority of the clients hold the course. So I don't know, 5% or less maybe make that pivot and change.
Now, how often are you seeing people go over budget on rehab costs?
Yeah, that's an interesting question. So on a $175,000 loan budget, it's easier to go over than on a smaller budget, I would say, because things are just costing so much more, right? In this case, there's 2 kitchens, 2 sets of appliances, more bathrooms, right? More windows in a bigger place. So when one thing changes, it escalates tremendously. Over the past several years with inflation hitting, everybody was going over budget, right? A lot of people were getting in trouble that, years in the years past, when we had that 10, 15, 20+% appreciation, even when they went over budget, they were kind of saved because their budget went up, but their ARV also went up. And so they're still being successful. But when you have change orders and when you have cost overruns, generally it also takes longer to do the project. So now your holding time is going up, right? Your costs are going up across the board. And so people were being saved by those ARVs going up. Now we're not seeing that as much, right? They've stalled out, or it feels like they've stalled out, even though they are still appreciating. And so people are being a little bit more conservative. They're being smarter. They're getting more quotes. They're trying to lock in pricing. They're buying more material up front to lock in the pricing of their budget and be more smart about it. So I would say less people are going over budget these days, but that's because a lot of people got hurt over the past couple of years in their budgets changing.
Yeah, I think you're exactly right. Now, walk us through the benefits and risks on this, if you would, Justin.
Yeah, so the benefits, right? Amazing ROIQ, right? Over 100% return on investment quadrant, which is amazing. Seemingly very little cash into the deal, still over $50,000, right? But no money upfront at closing. You had the monthly payment, so it added up to 50 grand, but that accrued each month. And for the size of the deal and the scope of what you did, extremely little cash into the deal. Mm-hmm. So if we had, what if we had $250,000 and we were able to find 2 or 3 of these things? Could you imagine? And you would still have a bunch of money left over in your pocket. So the ability to purchase more and more properties is incredible using this strategy. And you should still have some good cash flow. Now on this one, not necessarily in year 1, but very soon after, you should be having some really good cash flow. But the other side, right, is the loan qualifying is more difficult because it's a much larger loan we're looking at. You're qualifying for 2 loans, the hard money loan, which although is usually a lot easier to qualify for than Joe's loan, but you have to qualify for the hard money loan and then also for the refinance loan. You're going to have less equity in the property, although you're still going to have at least 25% because that's Joe's limit, right? At 75% loan to value, you'll still have at least 25% equity. But if you bought a property with one of the other scenarios and then did all the rehab, you would have a lot more equity in the property. Vacancies have a much higher impact because it's such a large mortgage, right? Or larger mortgage. Even if we went back to, what was it, scenario 2B, where we did the $25,000 remodel on the basement apartment, you could potentially use this strategy for just the $25,000 repair budget. But if you're doing that, we're trying to borrow all of that purchase price and the repairs. So we're not borrowing $500,000 here, but we are borrowing more money than if you just went straight to Joe, put 25% down and paid for the repairs out of pocket, right? So you may not have to put cash into the deal at closing, right, on the refinance or upfront, but you still need to have good cash to qualify for the loan, to be prepared for the monthly payments, to be prepared for change orders. You may have to pre-purchase cabinets, right? But you're not going to get maybe a draw for the cabinets until later on in the deal. So you may have to have pre-purchasing some materials along the way, right? And things just get sideways on deals. Contractors skip out on you, other things come up, and you got to be prepared for that when you're doing rehabs, regardless of the size. And then, of course, something really, really important to understand is I get an appraisal on the front end. Joe gets an appraisal on the refinance. And an appraisal is an opinion of value, right? It's a professional going out and doing their professional job and their professional opinion, but it's still an opinion. And so our values may be different, right? Joe's may be higher than mine, which would be great, or it could be lower than mine. And if it's lower than mine, things may change a little bit. And so what we found is you got to be prepared to put at least between 3 and 15% into the property. That could be upfront when you buy it with the hard money. And if you do that, maybe you don't need any money on the refinance. Maybe we get a solid deal up front and you don't need any money up front with the hard money. But then on the refinance, the appraisal came in a little lower and you need to put some money in there. Either way, whatever it is, be prepared to put some money into the deal. And either way, you're buying and owning a rental property, and we're going to have turnover. We're going to have costs and expenses and turnovers and things like that. And so we have to be prepared for that and have money no matter what. So regardless of using hard money, putting a bunch of rehab into it, you will have to rehab these properties eventually. And you must be prepared and have some money in your pocket for those.
Yep. Now, we did have a question here. What history do you need as a landlord to qualify for the end loan? We do not require any sort of landlord history. So as long as you've got sufficient income, sufficient reserves, and sufficient credit, and you've got the property rented out, that's great. We just need a copy of the lease and the initial rent check to show the new rent payment on the new property. And there's no landlord history or no landlord time frame or minimum number of properties. So really good question. All right. I think this is pretty solid to buy one of these with a hard money loan. Justin, you do this all day, every day, so I think I know the answer, but what do you think? Good deal?
Absolutely. If you are prepared to manage contractors and have a rehab project, right away.
Yeah.
It's an incredible deal. This is what I do all day, every day, is talking to people, coaching them through it. Folks like who are listening to this right now, who sat through it and listened to us explain this all. Tomorrow, I'll probably talk to one of the people watching this video and say, hey, walk me through that again. And I'm happy to do it because it's such a powerful strategy and such an unknown strategy that I love talking about it. And I love seeing people take advantage of it and be able to really start growing their net worth, their real estate portfolio through some of these different scenarios.
Yeah. Now let's talk about scenario number 4. And Justin, can you put your contact details in there in the chat box, but we'll also have those at the end. But let's talk about scenario number 4, purchasing a multi-unit as your primary residence. So this was another single family home with a basement apartment purchased for $475,000. Now the new loan amount was $451,000. Now, Justin, we spoke earlier, minimum down payment for an investment property is 15%. But this person only did 5% down. How were they able to do that?
Because this is not an investment property. This is their primary residence.
Right. It's a primary residence. So if you're living in the home, you can buy with as little as 3.5% down on FHA, 3% down on conventional if you're a first-time buyer, or 5% down if you're on conventional if you're a non-first-time home buyer. So down payment needed, $23,750. Closing costs a little bit more. When you're putting less money down, you need a little bit more in closing costs. Total cash to walk out of the title company with the keys, $31,250. So this was a basement apartment that already had a basement apartment, but it was non-conforming. So they had to put in 2 egress windows. 3 egress windows, as I recall. I think they paid about $2,000 per egress window. Total cash into the deal, $37,250. Now, annual rental income is really neat on this one. All right. So they rent the upstairs for $2,000 a month. The basement has 3 bedrooms in it. The owner lives in 1 bedroom and rents out the other 2 bedrooms for $600 a piece. So their annual rental income is, their monthly rental income is $3,400 a month times 12 months, and they're living in one of the basement bedrooms. Now, not the most comfortable living situation. Let's be clear, a little bit of a tight fit down there, but they're really happy with it, and I'll show you why. So they make about $40,000 a year gross, minus vacancy, reserves for repairs and maintenance, property taxes, and property insurance. There is no management because they live there, they manage it themselves. So net operating income, $31,000. Annual mortgage payments of $35,000 plus $1,940 in mortgage insurance. Annual cash flow, negative $6,000 per year. It's a terrible deal, right, Justin? Why would they do that for negative $6,000 a year in cash flow?
So, Joe, this is it's like a complete mindset shift, right? I know what's coming next on the slide, and it's you really just gotta like soak in what Joe's about to tell you here, because it's fascinating, right? The mortgage payments are payments that have to be made, right? But on all of our rentals previously, who's making those payments?
The tenant.
Us or the tenants? The tenants, right? But this is our primary residence, right? So on our primary residence, we're used to paying our own mortgage, but it's our primary residence and we have tenants. So really, if the tenants are paying that much money, what are we doing with that money that we would normally be paying for our mortgage? Well, we're not paying for our mortgage. So what would we do with that $37,000 that we should normally be paying for our primary? Well, if
save it.
Yeah. What if we just save that money? What if we take that money, instead of paying the bank, the tenant pays the bank, and then we just set that money aside?
Yeah, you're spot on. So this particular investor, he knows that the mortgage payment is $37,500 per year. And he knows he's got to live somewhere, right? He's got to live somewhere to have a house, to have a roof over his head. So he's going to spend $37,000 a year. Well, $500 of that every month has to go to pay the mortgage, right? Because we've got negative cash flow. So his true cost of living is only $500 a month or $6,097 a year. And then he says, but I'm accustomed to making a $37,000 a year mortgage payment, a little over $3,000 a month. I'm going to take the difference and put that back into my savings because the tenant is paying the bulk of it, or the several tenants are paying the bulk of it, but he is going to take the difference and put it back into his monthly or annual savings into his savings account. So what does that do for our return? Well, this is a 6.5% cap rate, but holy cow, this is an 84% cash on cash return. So let's look at this. Our cash flow, $31,000, no depreciation because it's your primary residence. Can't depreciate your primary residence. Debt reduction of $4,600 a year, $23,000 of appreciation. That is a $59,000 return on a $37,000 investment. That is a 160% return. Justin, is 160% annual return, is that pretty good?
I would say that is very good. Yes.
Yeah, pretty solid, right? Pretty solid.
That's
so when do we get positive cash flow? Year number 1. So a lot of people talk about there's nothing out there. I can't find any positive cash flow. Well, there is positive cash flow out there if you're willing to live with your tenant. Now, I am not. All right. I am not willing to do this, but you know who this is great for? Young people that have recently graduated from college, young people that already live with 2 or 3 roommates, young people that are living in mom and dad's basement. So if you're an investor, talk to your friends and family about how they could help their kids buy properties. If you're a real estate agent, you could represent them in those transactions. This is a great way to show your clients, your friends, your family how they can build wealth in real estate. And 30 years down the road, this property will be generating over $300,000 a year from appreciation and cash flow. All right. So what are the big benefits of this? Holy cow, a 160% return on investment, only 5% down, potentially great cash flow. And I say potentially because you have to be disciplined to be saving that extra mortgage payment, right? You got to be disciplined about that. But what are the downsides? You have to live with your tenant. Justin, would you and your family do an investment like this?
At this point in our life, no, this does not make sense for us.
That's right. Generally works really well for single individuals or maybe folks that have a fiance, boyfriend, girlfriend, whatever, that would be comfortable living in a little bit of a tighter situation. You have to be disciplined to save your payment, and you need to live there for a minimum of 12 months. Now, the alternative, you could do something like this and live in the basement apartment all by yourself or with your spouse and maybe a child or 2 or dog or whatever, and rent out the upstairs or vice versa. So it doesn't have to be as extreme as I'm living in the smallest bedroom in the basement and I'm renting out everything else in the house. But there's different ways that you could do this where, hey, I'm going to live upstairs. I'm going to rent out the basement. I'm going to buy a 2-unit. I'm going to live in unit A and rent out unit B. Lots of different ways to make this work. For those of you that are familiar with the concept, this is called house hacking. If you're not familiar with that, we actually wrote a book on it that you can get from Amazon, and we teach a bunch of other classes on house hacking, but this is truly how it works. And where was this property? On the MLS, my favorite place to find properties. 1.3 months of inventory just a couple of months ago when we helped them buy this property. Now, did we have any questions in the chat? I think I saw a few. Justin's contact information, outstanding. All right. So how can Justin, I almost forgot. Which option is the right one?
This is the best part.
Yeah, I almost forgot. I got too excited to talk about how to call you. All right. We looked at 5 different scenarios. So we've got cash, 15% down, 25% down, hard money, primary residence. Which one has the least amount of cash out of pocket? Well, that's going to be this $37,000, all right? But that comes with a trade-off of, hey, I got to live with my tenant. I'm not sure I love that. Well, which one has the best cash flow? Well, same scenario, but maybe I like my cash flow up here, but I got to pay cash for the property. Well, maybe I'm not super concerned with cash flow, and I want the best return on my money. Well, that might be this scenario here, buying with hard money. But I'm not a great renovator. I don't know exactly how to renovate properties. Maybe I should put only 15% down. But I want to get cash flow as soon as possible. Maybe I should be putting 25% down. Or maybe I'm comfortable with deferred down payment and my cash flow will come at a later date. All right. What you're going to see, the more money you put down or the more sacrifices you make by, for example, living with your tenant, the sooner you're going to get cash flow. But if you're not concerned about cash flow right away, you can get really, really great rates of return by putting less money down. And the important point is it's a balancing act. And Justin, which one do you think is the right one looking at all of these?
I mean, it honestly depends. The classic answer when it comes to, real estate investing is it depends, because the one that's right for me is not the same one that's right for Joe. And it's probably definitely not the right one for anybody listening, right? We have to figure out what's best for ourselves. And there's lots of factors, lots of things to figure out. Joe did a great job of walking us through, this graph of which one and why and our thought process. But what is our personal financial situation? What's our risk tolerance? What can I qualify myself for? What are my goals? Where do I want to go and take this? What kind of tax implications are there? And are those important to me right now? Lots of things that we need to talk to ourselves about, talk to our spouses about, talk to our real estate agents about, to help us figure out what kind of plan we should be implementing.
Yeah, absolutely right, Justin. It really just depends on your situation or your client's situation on which one is the best. And now, Justin, how can you help us? You and I worked together for 12, 13, 15 something years.
Yes.
But how can you help the folks on the call today? What do you guys do over at Pine Financial?
So we do short-term, high leverage loans, hard money all day, every day. So the one we just talked about is what we call our rehab loan. It's where we can lend up to that 70% of the ARV. And with that, we want to cover 100% of the costs. So the purchase and the repairs and the closing costs, right? We want to cover all that stuff. Again, it's a 9-month loan. There is no mortgage insurance. There's no prepayment penalties. So that example we talked about, I think there was 8 months of payments?
Yep.
But there's no prepayment penalty. So if you paid us off in 30 days because you're only doing that $25,000 basement remodel and you can knock that out quickly, you could refinance with Joe in those 30 days, right? That's no problem for us. And it's no problem for Joe when we're doing a rate and term refinance.
Right.
We didn't talk too much about that, but it's really as easy as what we just described. We have a different loan, which is our acquisition loan. And that's where we lend 90% of purchase. And that's it. So we've got our rehab loan, which is 100% of everything. And then we have our acquisition loan, which is the 90% of purchase price. So the 90% of purchase usually works better for folks that are doing fix and flips. But sometimes if you're in a pinch, we could do that on the rentals as well. Obviously, the numbers are different. We could talk about that offline. But those are our two main loans. We've got a few other things we do. But like Joe said, if you're just getting started, if you want to dive deeper into these things, you can go check out our YouTube channel. Just look up Pine Financial Group. I don't know, 200 videos or something like that on there now. All about just across the board, different types of real estate investing. You can go to our website, pinefinancialgroup.com. If you want to just dive right in and get pre-approved, you can go to our website and start filling out that application. My email address is justin@pinefinancialgroup.com. And then our office phone number is 303-835-4445.
Outstanding. Justin, really appreciate all of your insight today. And then the very last slide is everything that I do at Castle & Cooke Mortgage. We can help you with conventional loans, FHA, jumbo, VA, USDA, our investor cash flow loans, helping you finance out of hard money. If you need a purchase loan, refinance, primary residence, second home, investment properties, even second mortgages for HELOCs, fixed rate seconds, just about anything you guys might need. And what's the big benefit of working with us? We've got our 8-day rush service. We have our average time to close in 21 days, our 100% pre-approval record. We have a great partnership with HomeBot to help you market to your clients. We've got our e-flyers, our websites for all of your listings, and what you're doing today. All of our classes are offered in person and online. Would love for you to join us for future classes, and make sure to follow us. Facebook, Instagram, LinkedIn, TikTok, and of course, YouTube at Joe Massey Lending. And the very last thing, you can download our free mortgage calculator just by scanning the QR code right there. So if you guys have any other questions or anything else that Justin and I can do for you, always feel free to call, text, email, send a smoke signal, carrier pigeon. Any way you want to get in touch with us, we would love to chat with you. Put a comment down below if you're watching the recording. And thank you all for joining us, and look forward to helping you start purchasing your next investment property.